record this session. So I just want to let you know we're now recording. I just wanted to, again, welcome you to the second seminar of the Jewish Federation Professional Advisory Council of the 2020-2021 year. It's entitled Happy New Year. Now what changes do I have to make to my estate and financial plan? So I will be facilitating and moderating, the seminar today. And I'll be introducing our speakers and panelists in just a minute. But for those of you who aren't aware, the Professional Advisory Council, or the PAC, is a group of attorneys, accountants, financial planners, insurance brokers, and wealth advisors that provide education to the Jewish community related to the wealth transfers to families and for charity. And the Jewish Federation, along with our 11 partner organizations, have asked their supporters, including many of you here today, to sign letters of intent indicating they are planning on leaving an after-lifetime legacy gift, which will leave a long-lasting impact in the Nashville Jewish community for future generations. More than 767 letters of intent have been signed in our Nashville Jewish community. This amounts to close to $21 million left in gifts to the Nashville Jewish community. 67% of those gifts have been formalized through a will, trust, life insurance, etc. The Life and Legacy Program is sponsored by the Jewish Federation and Jewish Foundation of Nashville in partnership with the Harold Grinspoon Foundation. And for all those who have left gifts, thank you for your support. I'll be emailing out the information from the presentations today. If you have a question, there will be time for questions after the presentation. At any time, feel free to use the chat feature. You can choose the everyone, so everyone can see your question, or you can send it privately to me. Either way, I'll make sure your question is asked to the participants, or to the panelists and the speakers at the correct time. If you don't want to use the chat feature, when it is time for the Q&A, I can also, you can do it verbally. Today, we're going to hear two short presentations for the first half of our program, and as I said, the Q&A for the second half. The first presentation is a review for some of the new people who haven't participated. It's new information. And again, for those of you who have attended before, it's a review. The second presentation is all new material. Let's see, our first presenter is Dave Heller. Dave is an attorney at Martin Heller, Potempa and Shepherd. His practice focuses on family wealth preservation, which includes estate planning, estate tax planning, and asset protection planning. Many of David's estate plans combine asset protection planning, estate tax savings, and planning for the family's future generations. Our second presenter is Howard Safer. Howard joined Argent Trust Company in April 2012 as the Chief Executive Officer. As the CEO, he serves families providing trust, investment, estate, and family office services. Howard has more than 3 decades of experience, and prior to joining Argent, he has served as president of a $900 million trust company, the managing partner for a 90-person CPA and consulting firm, and a CFO for a substantial private company, and a controller for the NYSE public company. So those are our two speakers today. I'm going to ask David Heller to start first, and I will be sharing my screen. So if you'll just give me one moment, I'm going to pull up his presentation. Let's see. Come on, there you are. Okay, Dave, I'm going to, hold on one sec. I'm going to put it in slideshow format for you. And whenever you're ready, Dave.
Okay, next one, please. Okay, so thank you everyone for coming. This is kind of a very quick overview because we could spend literally days on these topics, kind of going over wills, power of attorneys, and trusts. And one of the things we really start off with and emphasizing with clients, this has to be a team approach. It has to be a combination of your estate planning attorney, the accountant, the financial planner, the insurance advisor, and everyone has to work together to get you to the place you want to be. You can't really just go to one person and expect your goals and your vision for what you want to have happen is going to work out. So that's why we start off always by talking about it's a team approach. Everyone has to be involved together and work together. Okay, next slide, please. So let's go over some of the obvious things. I almost feel silly having to say this, but you'd be surprised how often this comes up with clients. Basically, what these documents are going to do for you is you're going to talk to the world through these documents at a time when you can no longer communicate. This could be that you're alive, but you've become incapacitated. Maybe you've had a stroke, you have dementia or Alzheimer's. Something has happened to you to the point that you can no longer communicate. And so these documents speak for you. Things like who's going to be responsible for your healthcare decisions, who's going to take care of your finances, and what happens to your assets, your stuff when you pass away. We kind of jokingly tell clients, we can't use the Ouija board or the magic 8-ball to figure out what it is you want to do. So you have to leave some sort of documentation that spells this all out. Okay, let's talk about the not quite so obvious things. Do you care about saving taxes for the family, surviving spouse and family? How do you want to protect your family wealth? So this is probably one of the #1 biggest issues that we discuss with clients. I cannot tell you how many times, the discussion will be something like, well, if I die and my wife gets remarried, how do I make sure her new husband doesn't end up with all the wealth we've been working to accumulate? How do we protect for the children? I die, things go to my daughter, she, is either married or gets married later. How do we make sure that if she got divorced later, she doesn't end up having to give her ex-husband half of the inheritance that she got with me? And, from my perspective, I want our assets to go from myself to my daughter to my grandchildren, not necessarily to her husband. My daughter can give to her husband whatever she wants to from the things that she has earned through her own energy and efforts. But most of our clients will come in and say, we want the things that we worked hard for to benefit the people we care about, and therefore we want to keep it in the family bloodline. Next slide, please. So we talked about how do you tell the world what you want to have happen? Well, we could divide these documents into 2 subsets. The first is, what documents do I need while I'm alive, but I can no longer communicate to tell people what I want? And then what about what documents do I need upon my death? So the 2 documents or 2 groups while alive, #1 is a financial power of attorney. And then the other subset here are healthcare documents. And this could be any combination of healthcare directives, which could be a healthcare power of attorney, could be medical directives, and also a living will. Now, I'm going to tell you, a living will might be the worst named document in the world of estate planning, because everyone comes in and they go, well, I have a living will, so I have a will. A living will is not a will. A living will is a healthcare document. It has nothing to do with how your assets pass. So it's really horrible, whoever started, this terminology, that they used the word will with regard to this document. Okay, so then after you pass away, what documents speak for you as far as who's going to be in charge of administering your affairs, winding things up, and how things get transferred and allocated? And that is a will or a trust. Okay, So let's talk about first that financial durable power of attorney. Basically, there's two versions, and the most common version is what we would call a springing power. And this is a document that says, hey, some point in the future, some point later on when I become incapacitated, here are the people who can, and then there's usually a laundry list of everything you could imagine. You'll pay a bill, sign a check, file my tax return. But this type of document only is going to become effective when you become incapacitated. And that's usually by having your doctor sign some type of declaration certifying that you have become incapacitated. You are no longer capable of handling your financial affairs. So this document, coupled with the doctor's statement, activates these people and their authority to do things for you. Every now and again, a little less frequently, can we stay back in the financial, please? Thank you. We do an immediate power of attorney. And so this is when someone comes in and they say, well, you know, my daughter's already been signing my name to the checks, to my checks for the last 2 or 3 years. And I say, well, that's great. Let's go ahead and make that legal as opposed to you forging mom's name. And so sometimes we do an immediate power where a client does not want to wait until they become incapacitated and allow the child to do things. So one of the most important things about this is it is only valid while you're living. We get calls all the time. Mom died, I'm her power of attorney. She died 3 months ago. How come the bank won't do anything for me? Well, the power of attorney will evaporate at death because at that point, the estate documents will take over. So again, you are usually incapacitated. Someone has to come in and handle your finances. And it's only effective if a doctor certifies that you're incapacitated. Okay, healthcare. There's 3 general documents. One is a healthcare power of attorney, very similar to the financial. Again, something has happened to you, but you can't communicate. So the healthcare document identifies who you want your healthcare providers to look to in making your healthcare decisions. And the second one is medical directives. And this is often where you get to choose certain options, yes, no, or elect certain things. And this is basically, I tell people, it's as if someone was sitting next to your bedside and said to you, if you could communicate with me, what would you tell me you want me to do for you? Well, you're going to communicate to them through these medical directives. And the last one on the healthcare is the living will. And again, it has nothing to do with being a will, but this is kind of end of life decisions. It talks about if I have a terminal condition, no medical probability of recovery, don't take extraordinary measures, keep me pain-free and comfortable. And then there's some questions about organ donation and tube feeding. Okay, so those are the documents that you need while you're living if you become incapacitated. The next group are the testamentary documents, documents that speak for you after you pass away. And again, we have a will or a trust, and sometimes we have them both together. So, but before we understand why we might have a will versus a trust and how the estate planning interacts with everything, I think we need to look first to understand how assets pass when someone dies, because it's not exactly obvious. Next slide, please. Okay. So we could take all your assets and we could categorize them in 4 different situations: beneficiary designated assets, jointly owned assets, assets held in a trust, or the catch-all, which is the will. So when someone passes away, the family comes in, we get a list of their assets and we categorize them. So here's how this works. Beneficiary designated assets, the most common ones would be a life insurance policy or a retirement account. They will pass to the people who are listed as the designated beneficiaries on the forms that were submitted. So I could have a life insurance policy that says, you know, when I die, everything, the insurance gets paid out to my daughter, Sarah. Well, maybe in my will, I have a provision that says my life insurance passes to my daughter, Catherine. the will have no effect. It will follow the beneficiary designation. Number 2, jointly owned assets, especially with a spouse. When husband and wives own things together, there's a bank account with both their names on it. The house, the deed has both their names. They are deemed to own it with what's called, embedded in that ownership, you automatically receive it on death, a right of survivorship. So I pass away, my wife and I, our names are on the house together, on the deed. I pass away, it automatically goes to my wife. So we see this problem in second marriages a lot, where they will buy a house together, they'll title it together, and then one of them will have in their deed that when they die, the house passes, in their will, the house will pass to their kids. Again, the will has no authority over a jointly held asset with a right of survivorship. It will go to the other person. The third way that assets pass, if you have a trust and you've put the assets into the trust, then the trust document will direct how things pass. And the last way is the will. So, the will to me is really a catch-all. If something didn't pass by a beneficiary designation, if it didn't pass by joint ownership with right of survivorship, if it wasn't in the trust, then the will direct how things pass. And so this is really only 3 types of assets. Number 1, something you own in just your own name. Number 2, something you own with someone else who's not your spouse, let's say, without a right of survivorship. So Shannon and I, we own a house that we rent out. We're not married. We would own it as tenants in common. Her, let's say 70% will go by her will, my 30% will go by my will. And what we often see is, especially with couples, oftentimes a will has no meaning because everything is either jointly owned, or you have a retirement account or a life insurance policy. And so everything passes by either, a beneficiary designation or jointly owned. The will doesn't come into play until the second of the couple dies. So this is mandatorily important to understand how assets pass when you start to structure your estate plan so that it accomplishes the goals that you want to happen. Okay, thank you. So what are the basics of a will? Well, first, it appoints your personal representative. So this is kind of the new name of executor is male, executrix is female. The personal representative is the gender neutral term for the person who has the authority to wind up your affairs, have access to your assets, pay your bills, file your tax return, things like that. With a will, you must go through the probate court system, because that is the process on how your personal representative gets the authority. Just having it in your document, in your will, does nothing. The will then has to be accepted by the court into probate as the most recent will that you did, and then they will give your personal representative that you named, the authority to act for your estate. So we get this all the time. Mom died, she listed me as the personal representative. Why won't the bank, let me do something? And the answer is because you're not the personal representative until you go to court and get the authorization. Once that occurs, expenses and debts are paid, and then the remaining assets are distributed. And a will can either distribute things directly to a person or set up a trust for them. So what are the benefits and issues with a will? Well, a will, usually pretty straightforward, not difficult to create. And most of the activity really occurs after you die through that probate process. But again, you have to go through the probate process in order for the will to be effective. Number 2, with a will, there's lack of privacy. Probate is a public event. Everyone can come see what your will says, who it goes to, how it got divided up. And in many instances, someone may have to file what's called an inventory listing all your assets. That too can become public record. The last thing, and this is, again, the thing that we really focus on with this concept of family wealth preservation. It can be very difficult in the long run to protect assets for spouse, kids, grandkids with a will and prevent outsiders from coming in and getting anything. And I'll give you a quick little example of that. In Tennessee, as in almost every state in the country, I think except for one, I think it's Georgia, you cannot disinherit your spouse unless you have a prenuptial or a trust. And so this is called electing against the will. So I die, my wife gets remarried. She has a will that gives everything to the children. We have 3 daughters. She dies later. Under Tennessee law, her husband can come into court. And as long as he was married to her the day she died, and as long as they didn't do a prenup, he is now legally entitled to a portion of all the assets that would pass under my wife's will to the girls. So while almost every state has this law, they will have different algorithms or formulas on how to calculate it. So here in Tennessee, my wife's new husband's portion would work this way. If they were married less than 3 years, even a day, he's entitled to 10%. And some of this could have been things that we inherited from our family. It doesn't matter if it's passing by my wife's will, he can get to it. So 3 years or less, 10%, 3 to 6 years of marriage is 20%. 6 to 9 years of marriage is 30%. If they're married more than 9 years, he legally has the right to receive 40% of everything that passes under the will to the kids. Okay, so that's why a will can be somewhat problematic if you're wanting to make sure that the assets pass to the spouse and then to the children and then to the grandchildren. Okay, a trust. So a lot of our clients use a trust instead of a will. No probate, no court involvement. You do not have to do anything with the court, which, as we'll see in a moment, it keeps things private. No one gets to see what you have, how it got divided up. The trust is created during your lifetime and is operating during your lifetime, unlike the will. The will is really nothing but paper that has been printed on until it's accepted by the court. A trust is active and operative once you execute it while you're living. Similar to the will, it'll address how expenses and debts are paid and identify how the assets are distributed. And again, like the will, it can pass things directly to a beneficiary or can create trusts for them. So the benefits of using a trustworthy issues are, again, during lifetime, sometimes we have found that it's easier to help a client who has a trust if they become incapacitated than a power of attorney. We have had some issues with financial institutions not liking the power of attorney, but if the assets are in the trust, then the trustee has total control and it can be much easier to work with the incapacitated client. Number 2, again, like we mentioned a moment ago, you don't go through probate. There's no involvement of the court. Everything is kept private. Number 3, the trust is very effective for protecting family wealth because here in Tennessee, if assets pass to my children through a trust, the husband does not get that 10, 20, 30, 40%. It's only if the assets pass by way of the will. And there are lots of different trusts. We have lots of different trusts in Tennessee that can provide lots of different types of tax benefits and charitable gifting. We actually have trusts here in Tennessee that many other states don't have. So a lot of clients can take advantage of this where people around the country are not able to. One of the primary issue with a trust, it's more involved in setting it up. There's more involved in creating it, more involved when you set it up. But that also kind of conversely means there's less involvement on the back end after you die. It's easier for the kids. Next slide, please. Okay, so a lot of our clients, as part of their plan, incorporate charitable giving. And this is often because they are very charitable during their lifetime, and they don't see why the charitable giving would stop simply because they pass away. And so they often want to continue the lifetime charitable giving that they did even after they're gone. And again, that's can be embodied in the estate plan. Charitable giving can also give tax benefits, both during your lifetime and at death. Just like I'm sure everyone knows, you get an income tax deduction for charitable giving. There are estate tax deductions for charitable giving at your death. Different types of assets can have different tax benefits when they go to charity. And this kind of goes back to the first thing we said, where this is a team approach, because the financial advisors, the accountants, they need to be brought in to identify what type of assets you have and and some are much better for being used to give to charity than others. And again, especially again with the accounts and the financial planners, what is a good amount of charitable giving to put into the plan? It depends on the client, the family, the children. And so we all work together to help identify the planning and the giving that the client wants to have in their plan, not just during their lifetime, but also after they pass away. Next slide, please. So this kind of begs the question. We've been talking about estate and estate taxes, which I think Howard's going to get into a little bit more. So I just wanted to briefly touch as a kind of a segue into Howard's portion. We get this question a lot also. Well, what's in my estate? And my answer is everything. Everything you have is part of your estate. Real estate, cash, CDs, marketable securities, retirement accounts, life insurance. And for life insurance, it's the death benefit, not the cash value of the account. Business interests, and business interests are valued at their fair market value. If someone came up and wanted to buy the business from you, what would you sell it for? So that's not necessarily book value. That's not the amount of money you invested in it. It's what the fair market value is. Personal tangible items, promissory notes. So when we think about for tax purposes, sometimes people will say to us, well, because it didn't go through probate, it's not part of my taxable estate. That's not necessarily true. And so this is a fairly good list of all the different things that are going to be part of your taxable estate in determining what type of tax issues, if you have any, at your passing.
Okay, thank you, Dave, for your presentation. And again, if any of you have questions, please feel free to use the chat feature, or you'll have a chance verbally after Howard's presentation to ask your questions. I had already introduced Howard Safer from Argent Trust, so I'm going to actually have him come and speak, and I'm going to share my screen with materials that he would like. Okay.
All right,
Howard.
Good afternoon, yes. So you signed up for the changes that are going to impact you in 2021. Obviously, change of administration is going to make a lot of things change. And the day after inauguration, one of our associates put together an interesting list of what he believed to be the 4 most important areas that are going to be impacted. And you can get a copy of this for those of you that like to read the fine print, or you can Google each of these 4 areas. Clearly, everyone knows the history of how we got to the new administration. The income tax approach is one of those 4 areas. And the incoming administration is indicating an increase in taxes for those over the 400,000 in income level. Again, not changing rates for people below that level. But those of us that have seen conversations prior to the change know that a lot of this stuff changes midnight right before the final legislation goes in. Biden's proposal would take it from 37 to 39% at those lower levels. The second major area of the 4 is estate taxes. And 20 years ago, you had an estate tax if you had over 600,000, over $1 million. That exemption amount has increased to where today, as we speak, it's $11,700,000 per person that you do not have to pay estate tax on death to the federal government. Now, in some states, you have a state tax. We're happy to be in Tennessee, don't have that, but if you're in Connecticut or a lot of other more difficult states, Michigan, Georgia, you can have a type of tax that impacts you. The proposal is at that level. It could drop to 5 million, which is what it's scheduled to drop to January 1st of 2026. That might be index, so it might be a 6 million level, or Biden has talked about a 3.5 million level. So if you happen to pick all even numbers on the lottery that we just saw one, you'd have $700 million. And if you pick the right numbers ending in 02468, then you would have a lot of dollars overnight and be subject to this estate tax. The third area is a step up of cost basis. When someone dies, in most common law states, you go from what that basis was, a tax term for what you paid for it, and it gets moved up, stepped up to a higher value at time of death. Right now, those laws are in place, but the administration coming in has strongly suggested that they may want to make this a change where you don't get the step up, or that you get taxed at death, a forced tax out. So there's a lot that could be happening in that category. And the final area, capital gains tax, everyone is subject to capital gains tax. It just depends at what rate. But the new administration has suggested that at the $1 million or more level, that you wouldn't get the lower 20% or 20% plus 3.8%, that it would go all the way up to your ordinary income tax rates, which could be 39%. So there's a lot there and a lot to be concerned about. It's basically 4 areas. So there's more information just about whether it's going to happen or not. That changes virtually every day. Every newscast that you hear is going to pick up on some level. The most recent of which is Janet Yellen. When she testified before Congress, she's saying, and it's good news for everybody, that she doesn't think all this needs to be pushed immediately in this first year. All these changes that are there that won't, and many of them sound like they're at higher levels and they won't impact you. In the world of tax, typically it migrates down. So where there are these 4 areas to look at, I also want to reflect on every one of you individually. And I'm going to suggest that you fall into one of 4 areas. And to remind you that, I've got a thermometer up behind me, thanks to the Coca-Cola Company. And the Coca-Cola Company on this 1920 vintage thermometer says, refresh yourself. That's the theme, refresh yourself. And so that's the theme here that we want to get to. If we'll just stop there with the first part of life. If we're going to look at age, in the area of taxes, estate taxes, income taxes, we know there are 2 things that are certain, and that's death and taxes. That's supposed to have started with Benjamin Franklin. Others have been mentioned that involved in that. And we know that that's true, that you're going to get older. And so at the second line on top of this page, we're going to say that every one of us here would love an age of 100. Maybe you get to 120 or more, maybe you're like Sarah, but hopefully you get there, and maybe you win that lottery and have more than the 100 million. But one thing that you can picture is each age that you're at, it heats up. The needs that you have to do something in this field of estate planning, to think about legacy gifting, every quarter of your life stays. And so if we stay in that first quarter at the bottom of the page, we're going to see that starting from age 1 or starting at $1 million and even less, what you want to focus on, in my mind, is minimizing income tax, because the less tax you pay, the more you have in your estate, the more you can do what's on the top of this page, which says, look, everybody's goal is maximizing more for their heirs and for charities. I've never dealt with anyone in my many decades in this field that came in and said, I want to give the government more and I don't care about my heirs, don't care about charities, just don't want it to go to anything good. So bottom left there, you see that minimizing income taxes. Now, the good news for everybody on this call, you've got a break in the new law or the existing law. In 2020, you got to write checks for up to $300 and take a deduction, even if you didn't itemize. So most of you do not itemize on your tax returns. If you wrote a check to the Jewish Federation or United Way for $100 to each of them, up to $300, that was deductible. Next year, husband and wife, that's going up to $600. So that's one of the new things. It impacts every one of you that, again, that are filing as a couple. There are additional tax credits. The new administration has proposed dozens of additional tax credits. The theory is, let's make it easier and better for people that have children that are trying to educate them. An example is the suggestion that the child credit, a credit is where you reduce the amount of taxes. After you've calculated what you owe, you get a break, and they're suggesting it go up from $6,000 to $8,000. And of course, what's important as you start out in this first quarter of life, what I call the learning phase, age 1 to 25, while you're learning, go back to the basics. David did a great job of telling us what some of those are. So let's go to the second quarter of life from learning. We move to what I would call the growing stage. And this quarter of life, let's call it age 25-ish. And let's use that $3.5 million, which is what Biden proposes in estate tax. As income taxes, as you make more, you pay more. As you have a higher estate, the likelihood that the new rules will impact you. The significant thing, if the tax increases as discussed now, again, are supposed to only impact those with 400,000 in income. We think it'll be more and different than that, but we'll see. The use of Roth IRAs are available to everybody on this call. We've seen them done on children as young as 1 year old. You can have a child that makes income by being a model or by doing other earned income events. You can have a high schooler that is a camp counselor. If they earn, they can then put that into a Roth IRA and never pay taxes again. A very smart move that's open to everybody, but people don't think about it enough. I would say the more you deal with professionals, be it CPAs, attorneys, planners, the more of those type of ideas you will get. All of this is very customized. Timing of expenses. The rule normally is accelerate income and defer expenses, to do that in a change year. In a normal year that we've had up to now, most of the time, you're wanting to accelerate expenses and reduce revenues. So when these law changes come, and it may be this year, it may be 2022, the way you recognize revenue expenses will come into play. There's another change that's in the law that most people aren't aware of. You can do up to 100% cash deduction if you're very charitable. Most people don't do that. And I would tell you that it doesn't make sense necessarily to do that. You need to look at your future income flows and average out and try to get yourself to the right marginal brackets. Again, in the suggested changes, there's some suggestion that 1031 exchanges, real estate changes where you defer taxes are going to go away. So keep your eye on these changes as they come forward. Let's go to the third stage of life as we go up the thermometer, as we get to the third quarter of life, call it age 50, call it possibly in terms of a $6 million estate tax exemption. You're going to be more concerned. There's something that's creeping out there more at the state level than the federal level. They're wealth transfer taxes. California is seriously considering, when people move and leave there, New York's not far behind, they're seeing so much of a movement to Texas and Tennessee and Florida that they want to tax you on what your net worth is. So be aware of that change that's popping up. Again, we talked about the 39.6 on over $1 million, and we talked about the elimination of step-up basis that's going to impact more people in this age category, I believe, than some of the others. Again, depending on your net worth. But one thing you can do to step up, you are lucky you are in Tennessee, you can avoid tax step up not occurring at first death, being a common law tax state. In Tennessee, you can form a TCPT, Tennessee Community Property Tax. Assets that my wife and I have are going to step up no matter who dies first, giving us the benefit that exists in Texas and California, but being in a better state, Tennessee. And then remember, in those age categories, we see an awful lot of people saying, how much can I give to my children or grandchild, helping with different things that they have needs for. And that number is still 15,000. That's not proposed to change, but the new administration at some point has talked about putting limits on the total of that amount. So be careful. If you do that technique, do it sooner rather than later. And then we go up to the fourth quarter after we've done the first quarter of learning and the second quarter of kind of growing your assets. We're now in this maturing quarter in the third area. And then finally, the distribution. So at age 75, you may as well start thinking about it, because the goal of 100 you're getting closer to, something's going to happen. We're not going to spend much time on this because there are a whole bunch of alphabet soup names that people save taxes when they have significant large estates and they're getting up in age. They can use them at younger ages, but GRATs, GRIPs, SLATs, CRUTs, all of these LLCs, all of these are there and can be used. If you have issues in those areas, then we'll talk about that one-on-one as much as you'd like. Google them, find out about them. They will help people in those categories avoid that 40% or possibly maybe 50% estate tax going forward. Now, again, the last two are noteworthy. RMDs, that is required minimum distributions. If you have qualified plans, and once you hit age 72, the government forces you out to move that money out of qualified funds into taxable funds. And there are ways to use that. One of the best ways to use that, if you're charitably inclined, is to make gifts out of your total IRAs, your qualified plans. Again, if you're in your 70, 72 and more, you can make gifts. That is among the most effective ways to give. Also low basis capital gains tax with all those changes. And the final initial is QCD, Qualified Charitable Distribution. If you are age 70 and a half, you can take up to 100,000 of your RMD and you can distribute that, and you don't have to make that forced distribution. So those elements are available. You can have distributions from qualified plans earlier and when you have less assets. So these are kind of the way I see it, that you grow over those 4 stages in life. Things heat up as you get older. Things heat up as you get more. The knowns are your age. The unknowns are all the tax rules. So let's go to some examples to kind of bring this home, and we'll hit these in the same 4 categories. The younger group, 25 and younger. Jim Morrison is a good example. The Doors. He had a 2-page will. He didn't go to David. He went to someone that gave him a 2-page will and forgot all the other documents. At age 27, he died. His estate went to his girlfriend. She died 3 years later intestate. Fancy word for not having a will. Guess who ended up with his millions? Her parents, by the state rules that she was in. Big lawsuits, lots of fights. The good news is that his parents and her parents decided to split it as opposed to fighting for years to come. Heath Ledger, The Dark Knight, had international Australian versus New York domicile issues. He had a daughter with a $10 million life insurance, a wonderful thing to think about giving to charities if you don't need it, depending on reassessing life insurance needs. If you had put that in trust to begin with, the 10 million wouldn't have been in his taxable estate. And if the rate's 40%, 10 million becomes 6 million because of a 4 million estate tax. Let's go to the next quarter of people growing up and hopefully making more. There's Philip Seymour Hoffman, 35 million, age 46. Boy, he had a complex situation. 2 daughters were born with his longtime companion, and things weren't really in very good order. He didn't listen to his attorney, to his advisors, and things got out of date because, well, at 46, you don't think anything will happen. So you postpone, you defer. Let's come back to Tennessee with Elvis. He theoretically died with 4.9 million when you value the royalties as they did at the time he died. He was age 42. You know, he's been dead longer now than he was alive. His estate went to the daughter in trust to age 25. Big mistake in the opinion of this experienced trust officer. Documents used to say, I want it going, if it's in trust, to go at age a third at 25, then 25, 35, and 45. Most people we counsel, we say, look, don't put a date in there. Hold it in there. There's nothing to restrict you from doing everything that you would do otherwise. Maybe 25 was a mature age 100 years ago, but today we see lots of people that would be much better off if their assets were protected. Also interesting to note that Elvis's estate, because of his popularity, is more today than it was back then. And then Steve McNair, ugly situation, 26 million, he died intestate. And then his children and the widow couldn't get anything. They had to go to Tennessee probate court. David pointed that out earlier, to get $500,000 for each of the 4 kids to get his estate going. Let's go to the next category, moving up the line to age 75. Another local, Glenn Campbell, 50 million. Although the estate tax file, it's been suggested was at 400,000. Again, a big difference in maybe what the value of the royalties are. We'll never know because they did this in a revocable trust form, the form that David was implying is a better way to go where people don't know. He disinherited 3 adult children. The 5 children from the next marriage got assets. The 3 adult children filed against the estate, but they got nothing. His documents held up because he did, look at the second line on this slide, sooner is better than later. In each of these examples, if they had done something sooner rather than later, if they had done refresh yourself, you know, you've got a tax law change, let's do something. David Bowie, he 100 million, age 69, he had a complex family. He had trusts. They were pretty interesting, pretty sophisticated, but they didn't do the right job. Today, we can decant those trusts, just like decanting wine. We can pour assets from one trust into another trust that gives you a better lifetime result for the heirs. But you can't do it unless you pay some attention to it. And then finally, as you go to the 4th quarter into the age of distribution, my favorite is J. Howard Marshall. There was the 1.6 billion. He was age 90. Poor Anna Nicole got, at age 27, got nothing. Didn't have documents, sued all sorts of ways, but it went to just one son. Anna Nicole and the other son were disinherited because there were good documents to protect him, not during his lifetime when he was doing some strange things. And then to bring it really locally, back in the end of 1990s or so, Alvin Beeman, the Beeman Auto area, had millions, age 85-ish, and he had a problem with capacity. And as he was losing capacity, different daughters, his son, Lipscomb University and others would be advising him, and he would pretty much agree to anything in the last person that talked to him. And so that's a case that was reported. If you're interested, it's local. It's in the Tennessean. It's one of the few cases from Nashville that made the front page of the Wall Street Journal. And hats off to Harris Gilbert, who, a matter of public record, helped get all the attorneys together to come up with a conclusion that met the needs of all the players. And also hats off to, who also helped to Joe Kraft, a CPA who helped really endow this program we have at the Federation that is helping professionals help each of you. So again, each of these cases deals with mistakes that were made, things that could have been done sooner rather than later. And it means that each of you as an individual should take the time to look at where you are, project ahead as to where you think you'll best be, get good advice, and move forward with your planning.
Thank you, Dave and Howard, for your wonderful presentations today. Joining our speakers today for the Q&A is Marty Satinsky. Marty has been providing tax and financial planning services to individuals and businesses for over 40 years. He's worked with regional and international accounting firms, including 7 years as a tax partner with Coopers and LeBran. Mr. Satinsky currently practices in his own accounting firm, and he is the immediate past chair of our PAC. We're coming now to the question and answer part of our program. So I will kind of go through the questions that I've received. But at any point, if someone else has a question, please feel free, as we come to the end of our answering, one question, if you have another and you don't want to use the chat, you can take yourself off mute. So Diane is starting us off with our Q&A and says, if your daughter is a minority 10% owner in an LLC, you are 90%. Upon death of the 90% owner, does the LLC pass to the daughter, or does the will have to specify? Can the LLC list rights of survivorship?
Well, typically what you'll see, hopefully, is an LLC agreement, which will determine what happens in the event of the death of one of the owners. It may be that it passes to the surviving owner. It may be that it becomes available to other members of the family to buy. It really depends on what the parties want when they form it. And it raises the importance in one area of having that type of an agreement, so that as much is covered as possible. Think of it as the will, a living will, for so to speak, of the company. Any other thoughts?
Yeah, I think the interest would still be directed by the will. The LLC agreement can do things, as Marty said, allow other people to buy it, force other people to buy it. But you're still going to need to have the will or something, because,
Yes.
Again, we talked about the personal representative who has the authority to, enter into that agreement. And so either that LLC is either your daughter's going to either have to create a trust, put the LLC into it, and the trustee would be in charge, or have a will that direct where it goes or the proceeds from the sale, but also identify the personal representative as the person who's authorized to engage in that transaction after death.
Agreed.
So question from Mindy. Dave spoke about power of attorneys. Can you talk about the importance of the power attorney for young adults?
Yes, and this is something that we've talked a lot with clients, and I'll just give you an example. My daughters are now 21, 23, 25. We did power of attorney documents for them once they hit 18 and they went off to college, because especially healthcare documents, they could be, hours away and they end up in the hospital. They're over 18. You need something that you can have, that you can send down to the hospital, to the doctor's office, that gives you the authority to communicate with them on your child's behalf. And so we try to do power of attorney documents for our clients, for their kids once they hit 18, and especially when they're going off to college. Very important.
And when you look at it from a different perspective, my wife and I have been married for just about 50 years, okay? And if all's well, be another 10 years or whatever. And we may not necessarily be have the right abilities to execute a power of attorney of that nature. So perhaps our children should be in a position to have that power of attorney as we get older.
Okay, thank you.
I would also add that one of the things that we've seen happen is where parents will put a stock of a company in an account for a custodial account for a child, and then when they reach majority at age 18, it becomes theirs. One of the things we were able to do over the years and still do today is do what we call a young adult trust. You won't find that name anywhere, but it's getting that new young adult who's still listening to their parents usually to take those custodial type assets and put them into an account that will be protected, that only goes to them, but keeps them. One of the key concerns is a failed marriage, a failed business venture of a friend. Those things are out there just all the time. And so where Dave implied it's a great idea to keep assets down your family line, it's also good to protect some of those assets you maybe weren't thinking about to start. So all these protections are very important.
Shannon, if I can make a kind of generic point, okay? Sure. We've covered a lot of material. We focus on a lot of the primary and basic approaches to dealing with certain issues, but everyone's situation is going to be somewhat different. For example, if I'll tell you, I have a cousin who has been married, had two children. Her husband, she got divorced, she remarried, and her second husband had two children as well. He named her as the beneficiary of her IRA for as long as she lived, with the remainder going to his children from his marriage, so that she didn't have control over, nor would it necessarily go to her children. It went into an IRA trust. So you've got to take that step back and look at your own situation and say, well, what makes sense for me? What do I really want to do? Can I trust my kids to manage the funds, or should they be in trust? Okay.
Thank you, Marty. A question from Bonnie. If most assets are in bank accounts, CDs, annuities, and the home and are owned by both, individual with spouse as POD, would a will or trust cover what's needed for transfer of assets? There are no children, but there are collectibles and they're doing appraisals for those. We currently have a will, power of attorney, and living wills and are in our mid-70s.
Okay, so if you have things jointly owned, and you might also have POD, pay on death designations, then what you have in your will may be meaningless, because those assets will transfer by the joint ownership and the POD. The difference between, and this kind of goes to what something Marty sort of mentioned a moment ago, we have husband and wives will come together. Well, first of all, I want to tell you, people come in and they say, we're easy because we have no children. And I say, no, you're actually more difficult because you have no children. Because when people have children, it kind of naturally often just goes from one generation to the next. There's a lot less variables when people come in with no children. So when clients come in without children, then oftentimes they have an agreement that says, hey, when the last one of us dies, here's how we want things to go. A jointly owned assets, payment on death assets, those will not guarantee that the second person follows that agreement that the couple has. Only a trust would make that happen. So the short answer is,
it has to be an irrevocable trust.
Right,
It has to be an irrevocable trust.
Right after the first one dies.
Right.
So will a POD and jointly owned assets, will they transfer the assets at death? Yes. Will they necessarily make sure that the agreement that the couple has as to where they go when the second one dies, make sure that happens? No, not necessarily.
Hey, did Howard or Marty, did you have anything else to add to that question? We have a couple more.
Well, let's go on.
Okay. It was mentioned earlier that there are some assets that have better tax benefits charitably, for charitable purposes. Can any of you just kind of run through what assets are better for charitable giving with regard to estate planning?
Well, I'll start and then Marty can fill in a lot more detail. Clearly, giving cash is what a lot of people do, and you do get that 300 or 600 deduction, even if you don't itemize. But giving low basis stock, meaning back to you paid $100 for some shares of stock and it's now up to 200, you avoid the capital gains. If you gave cash, selling it and paying capital gains is not a good thing to do. So whether it's stocks or any other type of asset, avoiding that capital gain is probably a very good place to start for most people. Again, as one gets older and has distribution amounts coming out of qualified retirement plans, IRAs, 401ks, et cetera, then to look to those plans when you're over 70 and a half, over 72, those are going to be very smart ways to avoid an income tax. And it doesn't matter whether those IRAs and all are holding stocks, bonds, real estate, that those assets are sold, but with no tax, and then they're distributed, again, with no negative taxation.
Yeah, Howard's hit it right on the button. The key is to avoid being taxed yourself on the appreciation in the value or in the income generated from the property. But again, always keep in mind, do I have enough cash to maintain my lifestyle? If not, what other assets do I have that perhaps would be of value to a charity where either they could sell it or use it in a lottery or something like that, which has value to them, has a market value, but not a personal value. So those types of things really have an impact.
And also, if we have, I think it would be good to note that when you have larger transactions, there are various techniques like charitable remainder trusts, where one can avoid that capital gains tax immediately now and get to pay it out over a period of time. So benefiting, if you're a little bit charitable and you're willing to follow the guidelines that are pretty well straight, one can distribute monies back to themselves over a period of 20 years or more, and even to children. And then the remainder can go to charities, and it's a much more efficient way to go. So I think one of the things, not only giving from current income, but looking down the road, what might one give down the road? There are testamentary charitable remainder trusts, meaning when you die, it goes into play. And that model is going to be important to people that want to spread out future monies into the future. Again, as Marty said it all when he said it's individual. Every case has elements that any of the three of us could say, well, what about X or what about Y? And you might agree or might disagree. It's your plan, it's your future. The more you have the facts, the more you consult with someone, the better answers you're going to get.
Okay, the next question I have is it was Howard's presentation, but anyone can answer, obviously. Howard talked about the step-up basis, and they're wondering just if you could talk a little bit more about the step-up basis and the tax piece. They just kind of wanted to, if you could expand.
Marty, go ahead.
Okay. Step-up basis has been around for as long as I've been around. And the concept is that when someone dies, the beneficiary of an asset, the person who receives the asset, takes in that asset at the value reflected in the decedent's estate. So for example, if I had a house that I paid $20,000 for years ago, many, many years ago, but it's now worth $250,000, and my children end up inheriting that house, they end up having a basis in that house of $250,000. Now they're not going to live in it because they have their own home. So they're going to sell it. And they're going to sell it basically around the time they get it. They'll sell it for $250,000 and have no gain, no taxable income on the sale of the house. Whereas if I had sold it the day before I died, I would have had $230,000 of income. So one of the benefits of a step up in basis has been the ability to hold on to an asset as opposed to perhaps selling it and then ending up paying a tax on it. But another thing to keep in mind, though, is that if you have an asset, again, as I mentioned, that you don't necessarily need or want, charities are a good place to give it. Because, you'll get the deduction. You aren't going to pick up the income. The charity then picks up the full value and will have no income, taxable income, when they sell the property.
So thank you. I think that clarified for that participant. There was one last question that I have from the participants, and that was with regards to life insurance being a child being, or whoever, a beneficiary versus a trust. And what, I think some people want to know, why would I go, to the trouble of creating a trust? Oh, Ruth, if you could stop sharing your screen, thank you. It's okay. It happens to me a lot. So I'm sorry, where was I? I'm trying to find the question.
Shannon, I think you were saying, this is Mike Levine.
Oh yeah, trust versus leaving it to a person.
So the really benefit of life insurance held in a revocable life insurance trust is if they reduce the exemption down to 3 million or 5 million. Right now at 22, 23 million per couple, if you have $1 million policy, if you have other assets of $2 million, it won't make a huge deal. But if they do reduce the exemption, the revocable life insurance trust is a great place to hold that insurance outside your estate.
But there's another piece to that too, and that is the personality and the character of your children, their ability to manage the money themselves, who their spouses may be, and whether you trust their spouses in dealing with the funds. So having the funds in trust with a trustee who you trust provides a certain level of comfort to a lot of people that the funds will be well managed and not thrown away by their children.
So I'm going to add.
Yes, go ahead.
So I'm going to add, I tell people that we are nasty, paranoid, disbelieving attorneys. And so, Marty said, do you trust your son-in-law? I don't trust any son-in-laws. I don't trust daughter-in-laws. I don't trust anybody. And so if you want to make sure that no one can come. So for instance, I die, the money goes to my daughter, the life insurance proceeds. She's married. She has a will that gives everything to her husband. She dies, it goes to her husband, my son-in-law, he gets remarried. Maybe he then gives it to his new wife. So none of my insurance ends up with my grandchildren. It ends up with my son-in-law's new wife and her kids from a prior marriage. The only way to make sure that whether life insurance, real estate, investments, it doesn't matter. The only way to make sure that the assets that you have will pass from one generation to the next is to hold them in a trust.
And I might add that we've worked with numerous folks in the past, and divorce is a 50% fact of life. And if you do it carefully in terms of beginning to transfer assets to children, grandchildren, if you do it in trust, if your documents lean on that vehicle, that's the way right off the bat to keep outlaws from taking what they believe is their fair share. And, divorce happens, and most people don't care that much for their divorced son-in-laws or daughter-in-laws. And, if you need a more emphasis on those points, you can ask me about it later.
I mentioned before with the IRA, my cousin who has two daughters, and she inherited an IRA for her life, remainder to his children. Well, she's doing the same thing with her IRA, and is doing the same thing with my advice with all of her assets, because one of her daughters is married for the third time, has no children, whereas her other daughter does have children. So the assets are split, so to speak, into two trusts for the life of her two children. But at the death of the daughter who has no children, the assets then will flip over to the family of the daughter with children. And it was a fascinating meeting. We did this about a year ago. My cousin came down from Philadelphia. We drove down into Alabama, and we explained all this to the daughter who has no children. And she was okay because her husband was wealthy enough.
And let me take that story and just say one thing we should really stress is think about estate planning from a multi-generational standpoint. That is often that we have parents, grandparents, children, and some estate planning can go from the children generation to their parents and get a better tax impact. So when we're thinking about this from our own standpoint, it's often very important to find out what's happening with the prior generation or has already happened, what documents are out there. And there again, if the children are, if we've got those ages we've talked about earlier, age 75, 50, and 25, different stories for each one of them. What's the smartest way to handle taxes, to handle documents, to come up with the proper trust documents and wills in those cases?
Well, thank you guys. I didn't receive any more questions, so I'm going to wrap us up. I want to thank David Heller and Howard Safer for presenting, as well as Marty Satinsky for being on our panel. Thank you to the Jewish Federation of Nashville and Middle Tennessee, which houses the Joe Kraft Professional Advisory Program Fund and the Harris A. and Diane Gilbert Area of Interest Fund for Education, which both funds have supported today's program, as well as the PAC in general. Thank you for joining us, and we hope we've given all of you some valuable information that will assist you in getting started or continuing your financial and estate planning journey, as well as empowering you to fulfill your philanthropic passion and commitment to leaving a lasting gift to support the Nashville Jewish community. If you are interested in signing up for our last two seminars, there will be a link emailed to all of our past participants to sign up. I will be emailing out today's material from the presentations, as well as a roster of all our PAC members and the brochure explaining the rest of our programming for the year. And the sign-up link on the brochure is going to be old now. We'll replace it with a new link for the third seminar. I'll let you know when that's up and running. And we'll also post information on the Fed Focus, the Observer, social media with upcoming dates. And I just wanted, again, to thank everyone for joining us and spending your lunch hour and 20 minutes with us. And we hope to see you all at future seminars. Thank you again, and have a nice day, everybody.
Thank you, Shannon.
Thank you.